Live now. Thank you. We're live.
Okay, good morning. Thanks for joining us. You're welcome to the 5th session of our COVID-19 webinar series. This morning, we're going to focus our conversation on the Nigerian Common Reporting Standards. And essentially, we're going to discuss what you need to know. My name is Suleiman Yahya. I'm a senior manager with Anderson Tax, and I will be your host for this session. Before we go into the webinar proper, I would just like to give a quick rundown of the order of the events. We're going to have a very brief presentation by Emmanuel Onosami. Emmanuel Onosami is a manager in the transfer pricing practice of Anderson Tax. He has extensive experience supporting clients to comply with CRS. Emmanuel, essentially, it's our in-house guru on transfer pricing. So he's going to be setting the context for the conversation today. And right after Emmanuel's presentation, we've assembled eminent panelists who have very extensive experience on this subject matter. We will then be delving into the Q&A session. And at that point, we'll be taking comments from the participants. And once we have that engagement with the panelists, we'll be taking concluding remarks from there, and then we'll close. So essentially, that's how today's session is going to run. So I would like to, at this point, invite Emmanuel, and once Emmanuel is done with his presentation, we'll have a proper introduction of the panelists. Emmanuel, over to you, please.
Yeah, thank you, Suleiman, for that introduction. So I just want to quickly set the context for today. We understand that the subject of a common reporting standard in Nigeria is relatively new, and the audience may not have the background to this subject, so we would like to set the tone. The first thing I would like to mention is that if you have offshore assets and also you are also tax obligated, meaning that you have tax residence in another country apart from Nigeria, then you should take the conversation of today very serious. I come with that again. I said, if you have offshore assets or you are tax residents in another country apart from Nigeria, then you should take this conversation very, very serious. So our outline for this conversation, we will run through the background of the CRS, the objective of the CRS regulation, who are the people obligated under this regulation, and what are the type of accounts that will be reported, what are the compliance obligations, and we also see the penalties that are applicable if you fail to comply with this regulation. Yeah, I move straight to the background and to the CRS. If you are following the financial space globally and you are aware of the global depression that happened sometimes 2005, that led the government of the world to become very ingenious on ways to generate revenue required for governance. And one of the things that was observed is that multinationals have been able to arrange their affairs, their transactions, their assets in some locations that make it difficult for the government to tax. So that frustrated government revenue when it comes to the taxable base of each country. So the United Nations, through the OECD commissioned a project that we know as the Base Erosion and Profit Shifting Project, and because of this, they are trying to see how multinationals, businesses, individuals are trying to arrange their transaction in a way that they possibly avoid taxes. And also because we know that the world has become a global village, you can transact from the comfort of your bedroom without anybody necessarily knowing what has gone behind the scene. So the issue of transparency came to the shore for the government and the tax authority, meaning that before now it's difficult for tax authority to have a full information about the assets of people that are tax residents in their country. Also, it's also difficult to know the quantum and to even know whether you are present for the purpose of taxes. So the issue of tax transparency was one of the major pillars of the base erosion and profit shifting project. So the tax authorities said this launch a framework that can enable information sharing between each other, meaning that the government of Nigeria also is interested in this subject and has entered into exchange of information agreement with other jurisdictions. As at the last time I checked the OECD website for the number of countries that have agreed to share information with each other as relates to financial information of potential taxpayers in their jurisdiction, the number counted 108, and this is giving us a clue that is a serious matter that is happening globally. And Nigeria is not also lagging behind when it comes to this subject of tax transparency. And also to mention that there are a number of agreements that have been signed, and the number of agreements that have been signed by tax authority globally to exchange different kind of information, and the CRS is one of those information. You know, the CRS was actually a mirror of what has existed in the United States, typically called FATCA, where the United States expects that financial institutions should disclose to the IRS certain information about their citizens and their assets that they are holding across the globe, knowing fully well that such citizens will have some tax obligation in the United States. So the OECD also looked at this and said, okay, this is a tool that can be modified to achieve the level of transparency when it comes to people hiding their offshore assets and not doing full disclosure about their assets. So the CRS came on board, and the CRS then expanded beyond just one country. It's more like a dual relationship, you know, mutual benefit kind of relationship. So in under the CRS, you don't just see one country reporting to another country, a unilateral transaction like the FATCA. What is happening under the CRS is that there's a mutual transaction going on with exchange of information, where if Nigeria reports information about its citizen having tax obligation outside the country, it also expects to receive that kind of information from other jurisdictions that the relationship has been activated. So I will quickly go straight to how the CRS is supposed to work. And to put a context to it, the primary people that are obligated under the CRS regulation are the financial institutions that are holding the assets on behalf of the taxpayer or the account holders. So you have the account holders owning an account with a financial institution in a particular jurisdiction, say jurisdiction A, and that jurisdiction is now obligated to process some information about that account holder and share the information with the tax authority of that country through a secure IT platform. You know, and having shared that, the tax authority in that location will also process that information and then share it with any other jurisdiction or any member, any party, anybody that is a party to the agreement to share this kind of information. So you can see if I process all this information in country A and I make it available to the tax authority in country A, say Nigeria, Nigeria will then share with contribute that is a party to the agreement to exchange this kind of information, and vice versa also. So that typically describes how the CRS works. And if you then want to go to the specific of Nigeria, you want to ask the question that, is there a legal basis for the tax authority to request that I give some personal sensitive information about my assets across the globe to my financial institutions, such that will then be shared to other jurisdictions? And just to bring it to your notice that the FRS has not acted outside its powers. And if you are familiar with the provisions of Section 8.1 of the Federal Inland Revenue Establishment Act, you will see that where it was stating the functions of the board, it was clearly stated in 8.1I that the FRS have power to enter into agreement to exchange information and with both locally and both internationally. And if you look at other section 81T, 82, 27.1 and 29 of that same act, you see that the FRS also have the power to request this kind of information from the financial institutions, such that they can make it available to be shared. Also, section 58 and 60 of the CETA also gave the FRS the power to do this. Beyond this, also, we have the agreement that has been signed, and Nigeria has been obligated to begin to share information under this framework. You know, Nigeria signed this agreement on 17 August 2017, which is the MCAA to share financial account information. And because there's a deadline date to it, you know, this information then must be shared at that deadline date that has been set globally. Also, there are some other commentaries that are provided in the standard provided issued by the OECD on the CRS that also gives power to this regulation. So what is the objective of the CRS regulation in Nigeria? In summary, the CRS regulation in Nigeria is putting a legal force to the FRS needs to obtain this kind of information for the purpose of sharing with other jurisdictions. So, having established that, I think I need to bring to the shore who are the people that are obligated under these regulations. So I will speak quickly to the type of financial institution. And we have them in two broad categories. We have the reporting financial institution and we have the non-reporting financial institution. If you are a non-reporting financial institution, then you can go to bed. You don't have an express obligation under this regulation. And what are the kind of financial institutions that falls under the non-reporting FIs? We have the government entity, you have the International Organization of Central Bank. So if you have the IFCs of this world, the AFCs, the AFDB, they don't have express obligation under this regulation, meaning that any account they are holding, they are not obliged to disclose anything to the tax authority. Also, if you have any kind of fund that is for the purpose of retirement, you know, where you have a financial institution where that person is just housing retirement fund like our retirement savings account and all that, then that kind of fund is not also obligated to disclose any information under this regulation. Also, there are some exempt collective investment cycle, and the general idea is that if you have a kind of a financial institution that poses a low risk of being used to evade or avoid taxes, then that kind of financial institution also will not be obligated under the regulation. And you see also a special kind of trust that also poses a low risk of being used for evading taxes also may be exempt under this regulation where some certain conditions and parameters are met. So who are then the reporting financial institution? So these are the people that have express obligation under the CRS regulation. And the first is the depository institution. A big example is our banks. You know, the banks have express obligation to comply with the full provisions of this regulation. We have an investment entity, where you put your asset management companies and all that. They also have express obligation under this regulation. We have the custodial institution. So if you are managing fund on behalf of somebody, or you are a nominee, or you are a trustee, then you also have an express obligation under this regulation. And the last of the category is what we call the specialized insurance company. So the specialized insurance company are companies that issue cash value contracts. So in a sense, that is a technical jargon, but to simplify it, insurance company that sells life insurance products. So if you're an insurance company and you sell life insurance products, then you are also obligated under this regulation. So how do you then know that as a reporting financial institution, having established that, okay, I fall under the reporting financial institution, how do I then know that I have express obligation to comply? So you want to ask yourself, am I a financial institution? If the answer is yes, as defined, then you want to check again, am I a reporting financial institution? If the answer is also yes, do you want to ask yourself, do I maintain financial accounts of individuals and corporate entities? Then if the answer is yes, you then want to check and perform the due diligence required under the regulation and say, do I have any reportable accounts? If the answer is also yes, then you are obligated to report relevant information to the FIRS. And also the FIRS will then exchange this information with any country that has activated the relationship for exchange. So, and under this regulation, who are the kind of person or the kind of account that should be reported? And at the beginning of this presentation, I mentioned that if you have offshore assets or you are tax residents in more than one jurisdiction, then you are a subject under this conversation. So I will explain who a reportable person is, and you can put it in the context of yourself. So am I tax resident in more than one reportable jurisdiction? And just to set the distinction here, I'm not talking whether you are a citizen of another jurisdiction. That is not what we are checking under the CRS. What we are checking under the CRS is whether you have tax obligation in another jurisdiction apart from your country. So if you have tax obligation in more than one jurisdiction, most likely your account will become reportable. And the essence is that the tax authority in the other jurisdiction wants to check whether you have been able to discharge all the tax obligation with respect to the assets that you have in their respective jurisdiction. So if you are tax residents in more than one jurisdiction, then you are a subject for consideration. So, and for the purpose of implementing the CRS in Nigeria, we have two categories of accounts, and they are the pre-existing accounts and we have the new accounts. So the pre-existing accounts are the accounts that the financial institution are held or they are having with them as at 1st of July 2019. So any account that you have with a bank or with a financial institution before 2019 are categorized as pre-existing accounts. Any accounts that are opened from the 1st of July onward, then they are classified as new accounts. To say this distinction again, new accounts are accounts that are opened from 1st of July 2019 onward, while pre-existing accounts are accounts held before 1st of July 2019. Also, to set another context about the pre-existing account, we have different categories of pre-existing account that are for consideration here. So we have the pre-existing entity account. So these are accounts held by corporates and not individual like myself, Emmanuel, individual like my Suleiman. So accounts that are held by corporate before the 1st of July 2019 are referred to as pre-existing accounts. And what is the relevant threshold for this account? So if you have a balance of more than 250,000 USD in any pre-existing account as of 31st December 2019, and that entity is taxable in more than one jurisdiction, that account may become reportable after some other due diligence procedures that will be performed. And I move to the pre-existing high value individual account. So the high net worth of this world, they need to pay attention to this. So if you are an individual that you have in excess of $1 million in your assets with the financial institution as at the end of 31st December 2019, then you are categorized as pre-existing high-value individual accounts, provided you have tax obligation in more than one jurisdiction. And for the low-value accounts are those individuals that have less than $1 million in their account as at that date, 31st December 2019. And I move straight to the new account also. So we have the new individual account and then the new entity account. Remember, I said new accounts are accounts opened from 1st of July onward. And based on the express provision of the regulation, all new accounts, to the extent that the account holder has tax residence in more than one reportable jurisdictions, are reportable for the purpose of CRS. All new accounts are reportable for the purpose of CRS. But what about pre-existing accounts? So we are supposed to review the pre-existing account, perform some due diligence on those accounts and establish whether, one, they have tax residence in more than one reportable jurisdiction, and two, whether they meet the relevant threshold. So for the high value individual accounts, it is expected that the review is completed by 31st December 2019 and reported by 31st May of this year. No thanks to the pandemic and the current situation that we find ourselves, that has forced the OECD to extend the timeline for the reporting. So this deadline has been extended to 30th September 2020. So if you're an individual and you have an asset with any financial institution in Nigeria, and you meet this criteria such that your balance is more than $1 million as at the end of 31st December 2019, and you are also taxable in more than one reportable jurisdiction, then the financial institution will have the obligation to report your accounts to the FRS by 30th December 2020. For those that are low value, that is with a balance of less than $1 million as at 31st December 2019, the review should be completed by the end of this year and the reporting will be due by 31st May of 2021. But all new accounts, meaning accounts that are open between 1st of July 2019 to date, 31st December 2019, the reporting date is also 31st of May 2020, but now has been extended to 30th September of 2020. So in summary, the accounts that will be reported come 30th September 2020 to the FRS are all new accounts that are opened with the financial institution to the extent that the account holder has tax obligation in more than one jurisdiction. And the pre-existing high-value individual accounts having in excess of $1 million as at 31st December 2019. These are the two categories of accounts that will become reportable come 30th September 2020. Other category will become reportable in subsequent periods. So what are the information that the financial institution will be processing and will be making available to the tax authority? So, and I'm running out of time. I will have to rush this. So there are some personal information and we also have financial information. Just for you to know, if you are joining us live on this, is that the financial institution, we have to make available your name, your addresses and jurisdictions that you may have taxable presence. and they will also make available your tax identification number. They will make available your place of birth in the case of individual and your specific account number that you are holding with that financial institution. And when it comes to financial information, they will give the FRS information that relates to the interest you are earning, your passive income, your dividend, your account balance, your sales from any proceed of financial assets or capital gains that you may have. So those are the kind of financial information that will be provided to the tax authority when the timeline is due. So the question now is that for the financial institution, maybe the KYC document or the anti-money laundering document they currently have do not give them the required information to make the determination whether your account is reportable or not. Then they will have to then reach out to you and perform an exercise that we call a self-certification exercise. Based on the OECD recommendation, a self-certification exercise is to be completed by the account holder, in this case the taxpayer also, and signed off providing information about your tax residency across the globe, and also providing information about your TIN and the kind of asset that you held in those locations, so that the financial institution can make informed information whether you should be reported or not. And you need to listen to this, that it is very important that you cooperate as much as possible with the financial institution in making this information available. What will happen if you don't fill the self-certification form? What will then happen if you don't fill the self-certification form is that the financial institution will be forced, according to the regulation, to report you as undocumented. And once you are reported as undocumented, then the risk is high that maybe you are truly hiding something or not. So to the extent that you are sure that you discharge your tax obligation in every area that you have a tax footprint, then, or in every country that you have tax footprint, then there should not be any issue around filling the self-certification form, so that it can be clear that you have done the right thing or you should not be reportable. Also, if you don't fill the self-certification form, whether you are reportable or not, the financial institution will then have to report you to the tax authority. And also going forward, for the reporting financial institution, self-certification exercise will form part of the onboarding process in addition to your KYC and also the anti-money laundering form that is currently being filled. So quickly to the compliance obligation. So the compliance obligation is just described in this flow chart. So the people that are especially obligated at the financial institution, then they are expected to perform what we call the due diligence, and then they identify the reportable account. Where you have reportable accounts, you file your information return, which the first will be due by 30th September 2020, and then you document the process that you undertook in then arising at the accounts to be reported. If you don't have any accounts to report, you also file new returns, and you also document the process that you undertook to arrive at that new return. So the flow chart simplifies the compliance obligation for the financial institutions. So, and the regulation provided penalties for the financial institution that fail to comply with any provision in this regulation. And the first is the failure to comply with any duty obligation, which is a general provision. It is 10 million in the first instance and 1 million for every month the failure continues. And you can see that the penal offenses are listed, but what is very interesting is that the minimum of the penalty is 5 million naira. You get, and the penalty ranges between 5 million naira and 10 million naira, and you can see that this is material for any RFI that don't want to expose itself to unnecessary penalty. And also, in the event that an RFI decide not to comply with this regulation, it then leads to some potential reputational risk, where the tax authority or the international community may see that kind of RFI as an institution that can be potentially used to evade taxes. And on a final note, I just want to mention that the CRS is not another tax on its own, and but it's just a risk assessment tool for tax authority to determine whether taxpayers have been paying the right taxes where they are supposed to be paying it. So that will bring me to the end of my presentation. Suleiman, over to you, please.
Okay. Thank you very much, Emmanuel, for that very great presentation. I think Emmanuel has kind of set the context for our conversation this morning. We, at Anderson Tax have been telling our clients, given the last slide that Emmanuel just spoke to us about, the tax risk, from transfer pricing and international tax related matters, it's on the rise, by missing compliance requirements, deadline for compliance requirements. The exposure to penalties alone can be significant. It then, suffice to say that taxpayers need to pay attention to these compliance requirements. Thank you very much, Emmanuel, for that presentation. Very quickly, I would like to introduce our panelists who will help us unpack this subject matter. We have with us today Mr. Matthew Gbojibola. Mr. Gbojibola is a very familiar face in our tax space. He is the director with the Federal Inland Revenue Service, and he currently heads the tax policy department of the FIRS. Mr. Gbojibola is a seasoned tax administrator with extensive experience across various areas of taxation. He's served on numerous tax committees, both locally and internationally, and has led quite a number of teams at the FIRS, the last being the head of the international tax department. We also have with us this morning Nadia Ramsamy. Unfortunately, Johan could not join us this morning, but she's been ably represented by Nadia. Nadia has extensive experience supporting clients on implementation of CRS. She is a lawyer and works with A Tax Advisor, which is a collaborating firm of Anderson Global, based in Mauritius. She has been called to the Mauritian bar and has supported financial institutions in Mauritius to implement the common reporting standard. Nadia, welcome and thanks for joining us. We also have with us this morning RC Terblanche. RC is a very experienced tax administrator. RC used to work as the competent authority for exchange of information with the South African Revenue Service. He was there between 2010 and 2015, and while there, he assisted with the implementation of both the Common Reporting Standard and FATCA. RC has also assisted the FRS at some point with the Phase 1 Global Forum Peer Review implementation. Since leaving SARS in 2015, he's worked with the African Tax Administrators Forum as a technical expert on exchange of information, and he's focused basically on implementing exchange of information units and training revenue officials on exchange of information across Africa, especially in Angola, Ghana, Nigeria, Togo, Cameroon, Rwanda, Burundi, and a host of other African countries. So RC is very experienced on this subject matter, and he will be talking to us, especially from the IT side of Common Reporting Standard. And the three panelists will also be joined by Emmanuel, who is a manager in transfer pricing. So you're all welcome, and thanks for joining us this morning. So very quickly, Mr. Gbojibola, we're going to start with you. We do know that most of the times, you've been sitting at the table with the OECD. You've been there when all of these policies are being baked, so to say. So Can you just share with us, from the policy perspective, right? What developments led to CRS globally? Emmanuel touched on it, and from a Nigerian perspective, right? Why did Nigeria key into this initiative?
Thanks very much, Suleiman, and good morning, all participants and my co-panelists. Particularly, let me salute Harsi. We have worked together in about time, so it's a pleasure being on the same panel with you, Harsi. Yeah, to your question, Suleiman, the background to this was FATCA. There's nothing to hide there. Because when the US came up with the FATCA, there were a lot of cries and hues, and then some subtle resistance. But because US is hardly a country you want to resist, I think the whole world then did a review and realized that, oh, okay, we could also do something probably slightly better. So that was how AEOI was born. But before then, you must understand that when we talk about EOI, there are various shades of it. You have the EOR on request, you have the spontaneous one, and then we have the automatic one. So the automatic one was the latest in town. Now, why AEOI? What we have discovered globally, and not Nigeria, globally, is that people hold assets offshore, generating income. And those income are hardly repatriated or reported for tax purposes. And there have been instances in a few countries where the tax authorities have been able to get hold of information along this line. Don't let me mention any country, and which has generated huge amount of revenues for those countries. And so with that in mind, when FATCA came, it was like a high opener to everyone. The second issue is the issue of terrorism financing. It's also been discovered that assets held offshore, particularly that are never repatriated into, or on which taxes have never been paid, are also finding their ways to fund terrorism. And so quite a lot of political issues, whom the economic issues, you all recall the economic downturn of 2007, 2008, all of this led to all of this. Now, why did Nigeria join? Number one, Nigeria is a member of a community and therefore cannot act in isolation. That is one. Two, Nigeria is also the biggest economy in Africa. And so a lot of transactions flowing in and out of Nigeria. Three is that we can't afford not to participate in AEOI, because recall that around 2010, 2011, we were on the FATF blacklist of non-cooperating jurisdictions. And so that in itself gave us a lot of problem, even though it was not intended. And so getting ourselves off that hook, we don't want to find ourselves back there anymore. And so in summary, Nigeria is a member of a community. We have obligations to our trading partners, and also we are benefiting from the international tax work that are going on across the globe. So we can't afford to isolate ourselves. So that is why we are part of this.
Okay, thank you very much for that response. Like I said, you are always on the table when these things are being cooked. Thanks for that response. Nadia, I'll come to you now. Given that for us in Nigeria, this is the first year or first time, we are complying with CRS. I'm at our first year. And I do know that in Mauritius, you've had CRS for about 2 years or thereabout. Can you share with us from a Mauritian perspective, what was the experience like, when CRS was first introduced in Mauritius?
Yes, thank you, Suleiman. Good morning to all the participants, and good morning to my fellow panelists as well. as you've said, Suleiman, and I reiterate the comments that Emmanuel and Mr. Bunjibola made, in Mauritius, we became aware of the need to participate in all of this, especially because we had committed, as part of the BEPS action plan, but also we were becoming quite active in terms of the Global Forum on Transparency, and Mauritius showed political commitment to adopt CRS, as you've said, a couple of years back. So when it was introduced, we were one of the first African countries to ratify the MCAA, and I think a lot of people at the time thought that it would be very similar to FATCA. And of course, there are, we all know that FATCA was the starting point for drafting CRS, but there were some distinguishing features, especially in the sense that CRS covered a whole host of other jurisdictions. So I must say, at the very beginning, it was a huge awareness labor that had to be done by all the stakeholders, whether it was the Revenue Authority, whether it was the financial institutions, or the tax firms. So it was mostly about that at the very beginning. But now we've been exchanging for about 2 years, and it's and it's going well.
Okay, thank you. Thanks for that. RC, I come to you very quickly. You have extensive experience across Africa. What are you seeing across Africa with respect to CRS?
Good morning, everybody, and good morning to the panelists. And Matthew, acknowledgement to you. Great to see you again. CRS is a tricky subject to implement. One of the questions that I get often asked by revenue authorities is, what is the return on investment for a jurisdiction when implementing FATCA and CRS? And what is also important to understand is that revenue generation for a revenue authority is important, but FATCA and CRS is really a long-term investment for a revenue administration. We'll deal with some of those questions in a little bit more detail. But the other aspect is the complexity of FATCA and CRS and the implementation thereof, not only in the revenue authority, but also in a financial institution. And unfortunately, or maybe fortunately, depending on which side you're looking at it, the complexity is immense. And if one doesn't work with this legislation on a day-to-day basis, one can get easily caught up in the seemingly ease of providing or receiving information from an account holder. But what is very important to understand is what we're starting to see globally is that there is a lot of pressure being put on financial institutions to ensure that the information that they receive upon account opening is accurate and valid. So financial institutions are really required to obtain this information accurately and expeditiously.
Thank you very much, RC. Mr. Bunjibola, I'll come back to you. In the course of engaging, with financial institutions, they are asking us questions as well, and especially, we are seeing questions from the account holders, for instance, to say that, whatever I have in my account, perhaps my final entitlements and all of that. Now, because of the fact that I have tax obligations in more than one jurisdiction, right? My account detail then gets provided to the tax authority. So is this going to be another form of tax, or and some of them are a bit worried. What do you have to say to these categories of account holders? I mean, is CRS another form of tax? Will CRS be used as a basis for tax assessment, or how generally will the FIRS use that information that they receive?
Thanks very much, Suleiman, for that. First of all, let me put everyone's mind at rest. CRS is not another tax, and I think Emmanuel made that very clearly in his presentation. I heard him saying so, and that is true. It is not another tax. Is this an avenue to raise assessment? Maybe not, but there is a chance, because there's nothing to hide from one another here. Let's tell ourselves the truth. Now, CRS affects people who have assets offshore, in which case they have tax obligations in their tax residence, their country of tax residence. And if now they hold assets outside that country of residence, ordinarily, they are supposed to self-disclose those assets in their annual tax returns to the relevant tax authority. Now, what CRS is doing is to say, in case you forget to make a disclosure in your annual tax returns, that information will be made available to your tax authority, and then they can prompt you to remind you that it appears you have an asset bearing income in this other country. Do you want to check again? So, essence is not for Nigeria to tax you again, no. And for FIs, it's not a way to increase your corporate tax, no. For your customers, it's not for them to pay additional tax in Nigeria, no. The information required is for the purposes of Nigeria's obligations towards its treaty partners, specifically under the Multilateral Competent Authority Agreement for automatic exchange of information. So I hope I'm able to answer your question directly.
Yes, sure. And thank you very much for that. We hope that our listeners will find that clarification useful. I just stay with you a bit. In Emmanuel's presentation earlier, when he was looking at the compliance obligation, there is an express requirement for the financial institutions to make the information return to the FIRS via a portal. So FIs are asking to then say that is the portal ready? Is FIRS ready to receive those returns? That is, if I'm ready to make my information returns to the FIRS now, can I go ahead and do it? What's the state of that? Given that the regulation has said that the FIRS will make that portal available. If you don't mind, please. Share with the participants the status.
All right, thanks very much. A very key element of the CRS is the IT infrastructure, because the CRS works with minimal, if any, human manual intervention. It runs from machine to machine. And the beauty of that is the risk of leakage, unintended exposure to unauthorized persons are minimized. And probably let me start with the end. The CRS operates on a CTS, that is a common transmission system, which is a global system. It is not a Nigerian thing, it's not an African thing. It is a global system, secured system, on which the CRS runs. And there are stringent standards for a country, and it's only a country that can be enrolled on the CTS, not an individual, not a company. For a country to be enrolled on the CTS, there are very stringent conditions, particularly pertaining to data security and to confidentiality issues. And for a country to successfully start CRS, apart from putting in place the IT infrastructure that is required, it is also subject to international audit. Just permit me to use the word audit, because we are familiar with that. To certify that that system is safe, is secured, and is able to seamlessly work within the international system. And the software that drives CRS, I think there are just 2 or 3 companies that are certified to provide that software. So there are not many vendors for that. So that is to tell you how closely the system is policed. So with respect to the concerns of the FIs, I understand, because I know the value of information. You don't want to expose our financial institutions to lawsuits if information of their customers gets into the wrong hand through the wrong channels. So I can assure you that the system that the service is putting in place is not the service that has designed it. It is designed by the global CTS requirements. And one of the reasons why we couldn't meet the exchange for 2019 as we had wanted to do before we had a postponement to 2020 was because we had not been reviewed for our data security and confidentiality. We need to get a certificate. Like RC, I mean, when you were reading the profile of RC, it was part of the phase 1 of the exchange on information on request review. Now we have done phase 2, we have passed. Now we are going to have a separate review for automatic exchange of information. To not only look at our legal framework, they're going to look at our IT infrastructure. So the experts are coming. It's an on-site review. Then they're going to test and ensure that we have secured everything. So now I can assure you, and I can assure all our listeners, number 1, there's no risk that your data is going to get into the wrong hand, because nobody is going to handle it physically. It's going to run from machine to machine. Is there a possibility of hacking? Because I don't use the word impossibility, but in my view, it's less than 1%, because we are talking about a globally policed system. And now, as to whether the system is ready, it is a yes and it is a no. The yes is that we have installed all the required hardware. We have had the facility certified by the Global Forum. What we are currently doing is completing the installation of the software and moving into testing. And hopefully by the end of this month or early next month, we should be done with that. We are expecting the assessors from the CTS Global Forum combined together to come and assess the completed system. And that is where we have not been able to expose any of this to our FIs. Now, we have an obligation to get all information by September the 30th. I can tell you that long before that day we arrive, the system will have gone live by our own program with both our vendor and also our arrangements with the assessors who are going to be assessing our systems. So once we are at a point where we can begin to share information about the system, we will then definitely come back to our FIs. We're going to run a lot of enlightenment programs that we will use to educate all of our stakeholders as to how the system runs. Thank you.
Okay, thank you very much for that detailed explanation. And I think this is a very important point that FIs were looking, for clarification on. Thanks very much for that. IT, I just latched on Mr. Gbojibola's statement, talking about IT infrastructure and the role of IT in CRS. For the financial institutions who, have compliance obligations, we do know that if you take the large depository institutions, for instance, you could get tens of thousands of accounts to be reviewed and all of that. Given your experience in terms of using IT solutions for CRS compliance, both, on the tax authority, and the taxpayer side, how important do you think, IT softwares are, in terms of CRS compliance?
It is inevitable that a financial institution should invest in an information technology solution. The mere fact of reviewing pre-existing accounts is it's a significant task, and one can always look at it from the two angles. Either you're going to throw human resources at it in order to review the relevant information, but what that will require is that you need to train people, you need to inform them what the legislation looks like, and more importantly, they need to remember the requirements. And if you are then to review 200 or 300,000 accounts, or pre-existing accounts, you will take a significant amount of time, and you're going to use a lot of human resources to review such information. So when looking at the different combinations or different permutations, when you look at an individual, you probably get around about 365 different combinations of outcomes for an individual. And when you look at a financial or at a legal entity, we get more than 600 different combinations. And you may be wondering, why do I say 365 and over 600? So in the rules that we've developed over time to assist financial institutions in reviewing the information, we've coded the rules into our application so that it reviews this information and it processes this information just much easier. So just imagine you're sitting with an individual and trying to explain to him 365 different permutations. It is quite a lot of work. That's the one thing around the pre-existing accounts. The second thing around the new accounts, the opening of new accounts, I've mentioned it earlier, that the regulations require you to obtain upon account opening a valid self-certification. So I'm just going to reiterate it. Upon account opening, a valid self-certification. So it means that when a person or an entity comes into the financial institution and they open the account, that information that you receive must be accurate, must be valid, must be complete, and that the financial institution must then determine the reasonableness of this information. So unless you have an expert that is working 24/7 on these accounts, you're going to find it very difficult to train administrators, to train front office personnel, to over and above their already existing compliance or regulatory compliance framework that they need to do, especially under AML and KYC, to add this burden of FATCA and CRS to them as well. Over the last 5 years, I can safely tell you I've never come across a financial institution, and I've been consulting to quite a number of them, where they've managed to train front office personnel that gets this information or that gets this process right. So it is necessary for a financial institution to invest into the information technology to assist them to reduce the complexity of FATCA and CRS through an automated process, as opposed to try to train a person and get that person to remember all of the information at hand. And then you also run the risk that that this person may leave your organization, and then you have to start off new. So from a continuity perspective, from adhering to the regulations, it is my view that a financial institution must invest in information technology.
Thank you very much for that, RC. Nadia, I come to you again. So just like Mr. Gbojibola explained, right, the origin of CRS is basically FATCA, right? Some financial institutions are saying that we're already complying with FATCA, right? So I mean, how different is this from CRS, right? So that whatever information we prepared for, purpose of FATCA reporting, will it suffice for CRS? So if you don't mind, can you just explain to us what exactly are the main differences between CRS and FATCA?
Sure, Suleiman. Like we've said, CRS build on FATCA, but the reach of CRS is much broader. As Emmanuel said very clearly in his presentation, CRS is based on the tax residency of the person, and FATCA is mostly aimed towards US persons. So the definition of a US person includes a US national or a US resident. But that's quite limited. So if you have an FI, for example, trying to prepare its filing for FATCA, it will be limited as opposed to all the other participating jurisdiction that they will need to identify. So I think the first difference is obviously in numbers. The second difference is that with FATCA, you would need to register on the IRS portal, and then you will need to obtain a GIN, whereas for CRS, you register with your local revenue authority, and the process, you take it from there. The third difference is that there may be some very subtle differences in some of the definition. So the definition, if I may, the definition of an investment entity, for example, there are some minor subtleties, and I think FIs and practitioners in general, we should be careful when we are interpreting the regulation for both. So I would say these are the main differences, and also for FATCA there are certain type of classification that you would not get for CRS. So you can be a sponsoring entity, for example, and you may not have that for CRS. So whilst it's true to say that FATCA is the base of CRS, it would not be correct to say that you could, after having read CRS regulations or guideline, you could understand or blindly do the same for CRS. There is a certain level of caution to be exercised. And as I've said before, this is something we found when we were advising FIs on how to implement CRS, is that some of them said to us, oh, we're very familiar with FATCA, so we think it would be the same. And they often find, after we've advised them that the internal control framework that they require for CRS might have to be enlarged to the one they had for FATCA. So that's what I had to say on this, Suleiman. I hope it was helpful.
Okay, yeah, that's very helpful. Thank you very much. we just want to quickly take questions from the comments section from our participants. And Emmanuel, I come to you now. One of the participants is asking, how do you determine that your client has an obligation in another tax jurisdiction? So basically, it's a question from a reporting financial institution to then say, how do you determine that your client has obligation in another jurisdiction?
Yeah, thank you, Suleiman. I will respond to it that the regulation actually requests that the FIRS perform a due diligence. So the process of identifying that your customer's account is reportable reportable under the CRS is what we call the due diligence. And just to generally explain the concepts, because there are specific tweaks to each of the due diligence for the type of account, the idea is that if you check into the information you have about your client at the moment, both electronic and paper records that you have, and you are able to determine that that account is reportable, that is fine. You get. But if you find out that based on the information that you currently have at your disposal, you are unable to make a determination that that account will be reportable, then you will need to perform a self-certification exercise. So a self-certification exercise is where the account holder himself or herself will then fill a form confirming those information that are outstanding for you to make a determination whether the account is reportable or not. So those are the things that a reporting financial institution will need to do in order to identify whether an account is reportable or not. Thank you, Suleiman.
Okay, just staying with you for a bit. So there's also a question saying, are microfinance banks covered under the CRS regulation?
Thank you very much, Suleiman. And I would also like Nadia to comment on this. And because if you look at the express provision of the CRS standard and the regulation itself, the microfinance bank are not listed, but the general definition that we have is the depository institution. Yeah. So if you look at that umbrella and you check yourself as a microfinance bank, am I a depository institution? If the answer is yes, then you may want to check whether you have you have the kind of account that should be reportable. But there's another school of thought that may then want to look at it, and that is where maybe the tax authority or the OECD may then want to further help and say, based on the activity of the microfinance, are they going to be considered as financial institutions that have low risk of being used to evade taxes so that they can then be expressly exempted? But as of today, there is no clear provision that exempts a microfinance bank to the extent that they are part of the depository institution.
Nadia, do you want to add anything to that explanation?
Yes. Yes, obviously I cannot comment on Nigerian law, but I think Emmanuel's line of reasoning is absolutely clear. If they have not been listed as a low-risk institution, then you have to see whether the business activity, what the microfinance banks do, whether that is aligned with the definition of a deposit institution, so which would then mean it would be an FI. Yes, so I agree with Emmanuel on that.
Okay. Okay, Emmanuel, just one more question. So the FRS has just, announced the extension of the filing deadline to September. So come September 2020, what accounts are expected to be reported by that extended deadline? And what documents, will the FIs be required to provide?
Okay, I think I mentioned that during my presentation, but I will do that again for the purpose of emphasis. And the accounts that will be due to be reported come 30th September 2020 are first, all new accounts. all new accounts that are opened by the financial institution from 1st of July 2019 to 31st December of 2019, to the extent that the account holder has tax residence in more than one reportable jurisdiction. So all new accounts that you opened as a financial institution from 1st of July to 2019 to 31st December 2019, you are expected to have performed your self-certification exercise to determine whether the person is taxable in more than one jurisdiction or not. So if you are able to establish that that person is taxable in more than one jurisdiction, then that account becomes reportable by 30th September 2020. Just to mention again that for all new accounts, there is no threshold. Threshold is not applicable. So I go back, I then mention the second category that will be due by 30th September 2020, which is the pre-existing high-value individual account. And like I explained during the presentation, the accounts that have balance in excess of $1 million as of 31st December 2019. So if your customer's account fall into that category and you don't have all the information to make a determination whether he or she is tax resident in more than one jurisdiction, you will need to do a self-certification exercise to obtain that information and then make that determination before 30th September 2020, so that you can then forward the information to the FRS. Thank you.
Okay, thank you very much. Because we are moving towards compliance for the FIs, Nadia, given your experience, supporting, clients, in CRS compliance, what's in your experience are the pitfalls that FIs need to be careful of, especially given the fact that this is the first year of compliance?
Yes, Suleiman, thank you for that. I think I've mentioned this maybe twice now, but it is the amalgamation with FATCA. Of course, having FATCA and CRS obligation, there can be things that FIs do to minimize cost in terms of, you have only one self-certification form, for example, but you should not think that FATCA, having your system prep for FATCA is the same as for CRS because of the indicia, for example, that you will need to capture for CRS as opposed to, very limited one for FATCA. The second thing that we've noticed is that, of course, we're not talking about, in-depth training, as I think RC went touched upon that earlier. It's very difficult unless you're doing day in, day out CRS matters to be fully proficient in it. But we often find that some FIs they provide awareness and training sessions to legal and compliance and back office, and not to the front office staff, which are the ones who have to deal with the customer asking them 10 times, why do I have to do this? And it is, most FIs put the onus on the customer to fill in correctly the self-certification form and to provide the documentation. So even if the front-facing staff doesn't have a very in-depth appreciation of what CRS means, it's often very simple things like CRS is, an initiative of the OECD. Many countries are participating in CRS. You will need to fill in this detail. We cannot provide tax info, but if you go to that website or consult, just little things like that, we find that it might be helpful. The third thing that we have also identified is that some FIs tend to adopt a broad brush approach to their accounts. So, they're reviewing their internal processes on how to identify things. But if I can give an example, a trust holding an account will need to be monitored differently to a customer holding, a retail customer monitoring an account. For example, you would need mechanism in place to be able to identify a distribution, for example. So these are very subtle things that we are able to pick on when we perform gap analysis for our clients, for example. So I think, again, a bit of time should be taken to go in depth, not only through your own internal process, but then to see how you can add on to those processes so that you become efficient and that you are also supplementing things with, robust legal documentation. If I give you an example, if I give you an example, one of our clients, NFI, had what we call pooled accounts, and we had advised that their legal documentation needed to be amended. So in case if tomorrow there would be an audit, they would have that legal documentation to show for, and it would make things easier for everyone. So these are the things quite broadly that we've identified during the course of our work here.
Thank you very much. Arcia, given your experience as well, is there anything you want to add, on the common pitfalls that FIs should avoid?
Thank you, Suleiman. Absolutely. The design of the self-certification form is extremely important. If you design your self-certification form, and just remember, the self-certification form is not a document that the FIRS will prescribe to you. Some of you may have encountered the FATCA forms, the W8 forms and the W9 forms, but in designing your self-certification form, you need to ask the right information, and then you need to capture the relevant information. That's the first thing. The second thing is that, and just hammering again on an IT solution, a client, your account holder won't know what the relevant definitions are. They don't know what a passive non-financial foreign or passive non-financial entity means, or an active non-financial foreign entity means, or an investment entity that is in a non-participating jurisdiction. So in order to ensure that the client complete the information accurately and correctly, you have to have a very robust and clear account opening documentation. And that's the one thing. And then the second thing is that the concept around what is a valid self-certification form. One need to have, or a financial institution must design an exceptions process where you'll find that information does not make sense on the account application form, because if somebody at the front office cannot determine whether the information is accurate and valid, that there is an exception process where you have an expert dealing with your FATCA and CRS that can resolve the account opening documentation. And just the last thing is that getting the classification accurately is of utmost importance, and in order for that, you'll have to have a number of data fields in your database in order to make a determination whether an entity or an account holder is reportable or not. It is very important to understand that each account holder has must have a classification as either reportable or not reportable, because you may tend to think that I'm going to review and cure the information before the reporting time happens, and what happens with financial institutions is that 6 or 8 months down the line they find out, but we don't have enough information. So then you're going to phone the account holder or approach the account holder and ask them for additional information, and that just irritates account holders because you should have obtained the information upon account opening.
Okay, thank you very much for that. Listening to yourself, Nadia and Emmanuel, clearly the process of ensuring compliance with the CRS is something that a detailed attention needs to be paid to. given the technicalities involved, as well as the potential penalties for getting it wrong, just like Emmanuel articulated in his presentation. So I think the message here is that it's important for RFIs to, as much as possible, find a competent external provider who has extensive experience, to support them through this process, especially given the fact that in the first year of compliance, you are likely to make some slight errors here and there. Mr. Bojiwa, I come to you, right, as we come towards the end of this webinar. Of course, again, with compliance, new regulations and compliance issues, especially in the first year, the people who have the obligation to comply will often face challenges here and there. Is there any likelihood that the FIRS will, maybe on a case-by-case basis, grant any sort of extension to any FI that is, for whatever reason, unable to meet up with the deadline of September 2020?
Thank you for that. You know that the Federal Revenue Service is always willing to assist our taxpayers as best as possible within the law. And so we are always there to listen. Now, when it comes to the CRS obligation, the timelines that are there are globally agreed timelines, and therefore may not be altered unilaterally. For example, if not for the COVID-19 issue, the exchange, I mean, the return from FI should have reached the FRS by 31st of May, so that we could then exchange by the timeline within the global framework. Now, because of the COVID-19, the timeline globally was moved, and that was why the FRS in Nigeria was also able to move the timeline from May 31st to September the 30th. So as it were, therefore, it's going to be extremely difficult, if not impossible, to begin to grant extension of time to file. And maybe one more thing, Suleiman, is the fact that even that we have this COVID-19 should actually be a blessing in disguise for institutions who will have struggled a lot to meet the 31st May timeline. Now they have extra 4 months. So I believe that all the due diligence activity to identify reportable accounts, the reviews that they need to do, I think they have additional 4 months to do that. So I will encourage them to please, I know it's additional responsibility, but let's ensure that we meet that timeline. Thank you.
Okay, thank you very much. If I hear you very well, it is very unlikely that there will be any extension. And, so the message to the FIs is that they then need to speed up, the compliance process. Emmanuel, I come to you. So given what Mr. Bojibola has said, what do you think that the FIs should be doing right now? In addition, I just want to add, there's a participant that also asked a question that how does the due diligence procedure work? I know that it's an extensive procedure, but in 2-3 minutes, if you can summarize it.
Okay, I will take the last question first before the first. And the due diligence for different type of accounts are different. And I tried as much as possible the other time to broadly explain what it entails. So I will do that again. And first, you want to check the information you have at your disposal. you know that you've obtained some information through the KYC and the anti-money laundering forms. Check those forms. Are you able to decide whether this person is a reportable person or not? If yes, you don't need to do any further work. But if no, you need to do a self-certification exercise. And maybe at this junction, I also want to advise the financial institutions that you are not tax advisor. You are only expected to comply with CRS regulation. It is also good where a customer is not clear about his tax residency or his tax obligation outside the country, the account holder should seek the help of a tax advisor in ascertaining whether he or she has tax obligation based on his location of his assets. We understand that there are some jurisdictions where owning just a property there makes you taxable, you get. So a tax advisor is in a better position to advise the account holder and maybe not necessarily the FIs. So when you are performing the self-certification exercise, you want to ensure that the taxpayer or the account holder has provided accurate information as much as possible, just like RC has stressed. And if I then want to go back to the first question, which speaks, so Suleiman, can you remind me the first question, please?
Okay, yeah, so I was saying that given that it's very unlikely there will be any extension, so what should tax FIs be doing currently?
Yeah, so thank you very much for that. For financial institution, what we've observed based on our interaction with some people is that the KYC that they currently have is not adequate, meaning that a self-certification exercise is imminent. So, and because you have to engage your relationship officers to talk to your account holders, it may take some time before you get all these responses, before you can then make the return come 30th September. I think what the FI needs to be doing now is to be performing the self-certification exercise. And where you need guidance on this kind of exercise, you don't want to reach out to those people that have experience and can guide you on how to go about this. I think the financial institution needs to set up a review process for the CRS, set up a committee handling this, and ensuring that all the steps required to meet the deadline is on track. Thank you very much.
Okay, thank you. Unfortunately, you know, we're running out of time. I think we've had a very great time. So maybe I'll just go around the panelists and take your concluding remarks in 1 minute. Mr. Agbojiwala, please.
Thank you very much, Suleiman. I think my concluding remarks would be that to remind our financial institutions that Nigeria is a member of a global community, and we then cannot afford to isolate ourselves. There are many African countries who are already running with the AEOI. Nigeria should have been number one. We heard that Mauritius have done 2 years exchange already. So let's all join hands with the tax authority to make this a success. And let us avoid the unpleasantness of penalties. And let us know that this is not another tax, whether for the FI or for the individual accounts holder. Thank you.
Thank you very much, Mr. Agbojiwala. RC, over to you.
Thank you very much. It is very important to understand the complexity of FATCA and CRS, and automation is really the way forward. You will be sitting with a lot of frustration if you think that you're going to resolve this process by throwing number of resources at it. So I would really implore on you to look at automation end to end, from account opening to account classification to reporting. Thank you very much.
Thank you very much, RC. I think that's a very important point. Nadia, please.
Yes, thank you, Suleiman. I think what I would like to say is that given that this is the first year, I think many awareness and training sessions should be provided, by the FIs to their staff, but also to always be mindful of your supporting legal documentation, your policies and processes, and yeah, that would be it for me.
Sure. Thank you very much. Manuel, what to you?
Yeah, thank you, Suleiman. I think my final shot will be two. The first to the account holders that the fact on ground now is that we are in an era of unprecedented tax transparency, and there is nothing much more that can be done to hide assets globally. So it is important that you engage your tax advisors to advise you around your tax assets in different locations, and also cooperate with your financial institution in to discharge this or the obligation under the CRS. And for the financial institution, it's pretty obvious that you have just 2 more months to go, and if anything has not been done to ensure compliance with the CRS, I think you need to jump on this as quickly as possible and ensure that you meet up with the deadline as the Mr. Gbonibola has stressed. Thank you very much.
Okay, thank you, everyone. Just before we go, very quickly, we just want to make a very brief announcement that we will be organizing a training on designing an effective strategy for mitigating tax risk in the remote working world. We're in a COVID period, and this period is throwing up quite a number of challenges that we're all getting to learn. So this training is coming up on 15th July. We encourage you all to please register for this training. On this note, I want to say a big thank you to all the panelists. Mr. Gbonibola, thank you very much for finding time to attend. As a firm, we're always happy that you are always willing to engage with tax authorities, with taxpayers, and provide clarification as much as possible. Thank you very much for your time. RC, thanks so much for sharing with us your wealth of experience. We appreciate it. I believe very strongly that the participants will have learned a lot from this. And to Nadia, thanks for taking time out of your busy schedule to join us on this webinar. Thanks so much for the insights as well that you've shared. And Emmanuel, thank you for the very brilliant presentation. Thank you so much for participating. I think the message from this is clear. CRS, it's a bit tricky, so we encourage all the financial institutions to seek the right partner to work with to ensure that whatever returns they are filing is correct, is complete, and is accurate, to avoid any penalties, bearing in mind that years down the line those returns will be reviewed. Thank you very much. The COVID numbers are still on the rise, so we encourage everyone to please adhere to advice from the health authorities, and please let's all stay safe. Thank you very much for joining, and do have a great day ahead. Thank you.
Thank you, Suleiman.
Thank you. Bye-bye.
All right. Thank you.
Thank you. Bye-bye.